What if I told you that the most accurate, real-time indicator of the global economy isn't some government labor report or, a Wall Street index?
Right.
It's actually the price of a McDouble.
Yeah, honestly, it really is.
Because today, we are looking at a diagnostic landscape that is just incredibly hard to read. I mean, you pull up to the gas station and the numbers on the pump dictate whether you're going to take a weekend trip or just stay home.
Exactly.
But go to the grocery store and your usual weekly run suddenly feels like a luxury expense. There is this pervasive feeling of inflation right now. Wallets are squeezed and the consumer base is feeling the pinch on multiple fronts.
Oh yeah, everywhere you look.
So the big question for this deep dive is, how do we actually read the health of the global consumer right now without waiting for that lagging government data?
Well, you need a proxy.
Yeah.
You have to look at a single massive entity that interacts with millions of people across every income bracket in almost every country, every single day.
Right.
You basically put a stethoscope to the world's biggest restaurant chain.
Which brings us to our source material today. We have the complete, unvarnished transcript of the Q1 2026 McDonald's Corporation earnings call.
The big one.
Yeah, featuring the executives steering the ship CEO, Chris Kempczinski, and CFO Ian Borden. And our mission for this deep dive, well, it isn't just to read off a balance sheet for you. We are going to decode how a massive global brand reads consumer psychology, shifts its menu, and deals with internal hurdles.
It's basically a masterclass in corporate agility.
Exactly. Okay, let's unpack this. We're going to use our usual data-forward approach here to hit the headline numbers first.
Let's do it.
So looking at the raw numbers they reported, they hit an adjusted earnings per share of $2.83. They reported global system-wide sales growth of 6%.
Which sounds great on paper.
Right. But then they also highlighted a 3.8% growth in global comparable sales. So I want to translate some Wall Street jargon here. Walk me through the difference between system-wide sales and comparable sales, because it feels like there's a distinct narrative hidden in those two metrics.
Yeah, that distinction is, it's vital for understanding their operational health. So system-wide sales encompass all the money moving through the entire McDonald's ecosystem, including brand new locations they literally just opened yesterday. So if you build 1,000 new restaurants, your system-wide sales will inevitably go up just because you have a larger physical footprint, right?
Right, so it's just sheer volume of real estate.
Exactly. But comparable sales, which you'll hear called comps, those measure the revenue from restaurants that have been open for at least 13 months.
Ah, okay, so it filters out that artificial bump from just, pouring concrete and cutting ribbons.
Exactly. It measures the organic demand. So that 3.8% comparable sales growth, that tells us they're extracting more value from the exact same real estate they had last year.
Got it. And a key detail they mentioned is that this 6% system-wide growth is in constant currency. Wait, if I'm walking into a McDonald's in London paying in pounds, or in Tokyo paying in yen, why does the currency need to be constant on an earnings call? What are they mathematically stripping out of the equation here?
Well, they're stripping out the macroeconomic noise, basically, of foreign exchange rates, because McDonald's is a U.S.-based multinational.
Right, so it all comes back to dollars eventually.
Exactly. Eventually, all those pounds and yen have to be translated back into U.S. dollars for their financial reporting. So if the U.S. dollar happens to be exceptionally strong in a given quarter, the revenue from Tokyo or London looks smaller on paper.
Even if they sold, way more burgers.
Right, even if the actual number of burgers sold went up. So by reporting in constant currency, management is essentially freezing the exchange rates at last year's levels. It gives you, as an investor, a pure look at operational performance. It basically answers the question, did we actually sell more food, or did the math just change?
That makes a lot of sense. So that makes the 3.8% comp growth look like a very solid baseline. On the surface, the patient looks healthy.
Very healthy.
And the overarching theme from management throughout this transcript is that when they execute with discipline, they win, regardless of the macro environment. But I really want to understand the how. How do they achieve those numbers amidst an economy that feels so hostile to the average consumer right now?
Yeah, it's a tough environment out there.
It is. And management credits a specific operational framework they call the 3-for-3 playbook.
Yeah, so the 3-for-3 strategy, this serves as the load-bearing architecture for their entire global operation right now. It consists of 3 structural pillars.
Okay, what are they?
compelling value, breakthrough marketing, and great tasting menu innovation. And the thesis presented by the CEO is that when a local market fully activates all three of these pillars at the same time, the brand becomes highly insulated against external economic headwinds.
But the transcript doesn't ignore those headwinds. I mean, they paint a very stark picture of the macroeconomic reality. They specifically highlight a severe bifurcation of the consumer base.
Oh, absolutely. The split is massive.
Yeah, they explicitly note that the lower income consumer is under immense pressure. And here is the detail that jumped out at me. The CEO specifically called out elevated gas prices as a core issue causing declines in lower income traffic.
Yes.
They aren't just giving a generic, inflation is tough excuse. They are pointing directly to the cost of gasoline as the physical barrier keeping a specific demographic away from their restaurants.
Well, because gas prices act as a highly regressive tax on the lowest income quartile. Right. The transportation cost to acquire a low-priced meal suddenly becomes disproportionate to the value of the meal itself. If a consumer has a strictly fixed weekly budget and unexpected spike in fuel costs, it immediately cannibalizes their discretionary spending.
The drive-through run is the first thing to get cut.
Exactly. The quick service restaurant visit is the very first thing to go.
And yet, in the very next breath on the call, they note that higher income consumers remain incredibly resilient. McDonald's is actually gaining market share with the upper demographic.
Which is wild to think about.
It is. So they're bleeding traffic at the bottom of the income ladder, but aggressively capturing wallets at the top.
Yeah, and if we connect this to the bigger picture, this is where the genius of that 3-for-3 framework reveals itself, because it operates simultaneously as a defensive trench and an offensive strike.
Okay, break that down.
So the first pillar, value, is a purely defensive mechanism. It is engineered to stop the bleeding at the bottom, retaining that highly stressed lower income consumer who is tracking literally every penny.
Right.
Then the second and third pillars, marketing and menu innovation, those act as the offensive mechanism. They are designed to attract those resilient higher income consumers and maximize their check size once they are in the ecosystem.
Okay, I have to push back here though. If gas prices are the primary barrier keeping people away, how does making a burger 50 cents cheaper solve the math problem of a $60 gas tank?
It's a fair question.
If people literally aren't driving as much because fuel is too expensive, doesn't that present an existential threat to the fundamental geography of the drive-through model? I mean, you can't put a gas station at the drive-through window.
You're identifying the exact friction point the executive team is trying to solve. Because you're right, they cannot control the price of crude oil.
Right.
Therefore, the value proposition at the menu board has to be so undeniably compelling that it mathematically offsets the perceived cost of the trip in the consumer's mind. The utility of the meal must outweigh the friction of the commute.
I see.
If a lower income consumer is actively rationing their driving, a trip to McDonald's has to represent an absolute victory for their household budget to justify burning the fuel.
And this is exactly why you, the listener, should care about this deep dive. Because when McDonald's reports extreme stress at the low-income tier and high resilience at the top tier, they are feeding you high-fidelity economic data.
Real-time data.
Exactly. It's a direct reflection of the K-shaped economic recovery playing out right at the drive-through menu board. And that brings us to the second part of our breakdown, focusing entirely on that first defensive pillar, the value wars.
The foundation of it all.
Yeah, because if value is the foundation keeping this whole operation from collapsing under the weight of gas prices, we need to look at the mechanics of how they are engineering this pricing. The transcript details a massive evolution of the McValue platform in the U.S.
Yeah, and the implementation of this new McValue structure, it required a unanimous vote from the franchise field.
I want to pause on that process for a second. We are talking about thousands of independent operators who own the actual physical restaurants. Getting them to unanimously agree on a pricing structure in an inflationary environment seems nearly impossible.
It's incredibly rare.
Right, because every instinct an operator has when their own costs go up is to raise the price of the burger to protect their margin.
Which tells us how severe the traffic decline in that lower income bracket must have been. For an entirely decentralized network of owners to unanimously agree to compress their own margins, they had to be looking at internal data showing a catastrophic loss of market share.
So they were scared.
They were terrified. They recognized that protecting long-term market share was more critical for survival than protecting the short-term profit margin on a single transaction.
So what do they actually agree to build? The transcript outlines a two-pronged approach. The first is the implementation of an EDAP menu, everyday affordable price.
Right.
And this means committing to offering specific individual items for under $3.
The under $3 tier is the absolute baseline of affordability, but it functions alongside the second prong, which is the meal deals.
Right, the combos.
Yeah, so they rolled out a new $4 breakfast meal deal, which complements their existing $5 McChicken and $6 McDouble rest of day meal deals. And management specifically noted that the relaunch of these EVM's extra value meals in September 2025 was the catalyst that finally drove share growth with low-income consumers and improved their overall internal affordability metrics.
I want to dig into the behavioral psychology of why both of these prongs have to exist simultaneously.
Yeah.
Like, why isn't a $5 meal deal enough? I look at a $5 combo, and it feels like a complete psychological victory.
Yeah.
You get the sandwich, the fries, the drink. It feels like a real meal.
It does.
So why do they desperately need that isolated a la carte $3 item?
Because the concept of value is relative to available liquidity.
Okay, unpack that.
For the highly stressed consumer, $5 might simply not exist in their pocket at that specific moment. They might only have $3 of physical cash or literally $3 of available room on a debit card before overdrafting.
That's a brutal reality.
It is, but they require rapid caloric intake on brutally strict budget constraints. If your entry-level threshold is $5, you haven't just priced out a segment, you have entirely eliminated the bottom tier of your customer base. So the EDAP acts as a critical safety net.
And this wasn't some experimental gamble cooked up in a Chicago boardroom.
Yeah.
The transcript reveals the U.S. is actually playing catch-up to the rest of the world on this.
Oh, totally.
They explicitly cite their international operated markets, the IOM segment, as the blueprint.
Yeah, the European markets have been stress testing this architecture for years. Management highlighted Germany's McSmart platform and the UK's Meal Deal Plus.
I saw that.
And the UK iteration is particularly revealing regarding consumer psychology. For £5.59, customers get flexible choices among core and side items. And the CFO pointed out that introducing this flexibility drove significantly higher incrementality than their previous rigid £5 meal deal.
Let's unpack incrementality because that word is doing a lot of heavy lifting in this earnings call.
It's the magic word.
Right. From a purely mathematical business perspective, pushing a sub-$3 menu seems incredibly dangerous. If you make the $3 item or the $5 flexible combo too satisfying, don't you run the risk of cannibalization?
That's always the fear.
Like, why would I ever pay $10 for a premium Big Mac meal if I am perfectly satiated by the cheap stuff? Aren't they actively training their consumer base to reject their high-margin items?
Well, cannibalization is the perpetual terror of the quick service industry, but incrementality is the defense against it. Incrementality means generating a transaction that absolutely would not have occurred without the specific value trigger.
Okay.
The goal isn't to get a $10 customer to spend $3. The goal is to get a customer who is going to spend $0, who's just going to eat ramen at home, to walk through the door and spend $3.
It's an additive visit.
Yes. And while the margin on a standalone $3 item is paper thin, the strategy relies on behavioral economics. The first factor is the attachment rate.
Like fries and drinks.
Exactly. The consumer comes in for the anchor value item, but the ambient environment of the restaurant, the smell of the fries, the visual menu board, it triggers an impulse buy. They add a medium fry at full margin, or they add a high margin fountain beverage. Suddenly, a break-even transaction becomes profitable.
It's a trap, but a delicious one.
Right. And the second factor is the lifetime value calculation. If you keep the consumer tethered to the McDonald's ecosystem during their leanest financial periods, habit formation takes over.
Ah, I see.
When their financial situation eventually improves or when payday hits, they are statistically far more likely to return for a full margin premium visit. If you abandon them when they are broke, you lose the psychological real estate in their mind entirely.
You are treating the cheap burger as an acquisition cost for a long-term relationship. It's almost like a subscription model, where you let them pause their premium tier for a few weeks without canceling their account entirely.
It preserves the routine, and routine is the most valuable commodity in the fast food business.
So the value pillar is the anchor. It stops the bleeding. It gets the financially strapped consumer through the door. But earlier, we talked about the offensive strategy, how they captured the higher income consumer who isn't worried about the price of gas.
Right, the ones with disposable income?
Yeah, that consumer has infinite choices. They could go to a fast casual spot, a premium burger joint, anywhere. What gets them excited to choose McDonald's? This brings us to the next section, cultural capital and the second pillar of their playbook, marketing.
Yeah, and the transcript details a marketing apparatus that has completely abandoned the concept of traditional television commercials.
It's wild.
They are no longer advertising food, they're manufacturing cultural events.
The specific campaigns they discussed on the call are just fascinating. They mentioned a nostalgia campaign based around the 90s television show Friends that ran in the UK, Australia, and Italy. That feels like a very deliberate demographic strike.
Nostalgia is an incredibly potent behavioral driver, particularly for older millennials and Gen X.
Right, our age bracket.
Exactly. This is a demographic that now holds significant purchasing power and is often making the dining decisions for entire households. By associating the brand with a comforting, familiar IP from their youth, they basically bypass the rational evaluation of the food and tap directly into emotional resonance.
Just hit them right in the feeling.
Exactly. But the nostalgia play is just one layer. Their approach to scaling global intellectual property is far more sophisticated.
Let's talk about the Netflix partnership, because they launched a campaign tied to K-pop Demon Hunters.
Yes, massive show.
And they explicitly stated this was designed to target a digitally native customer base, but it's the mechanics of how they deployed it that fascinated me. The transcript mentions dual day part offerings with digital activation in the McDonald's app.
We need to deconstruct that phrasing because it outlines their entire digital architecture.
Please do.
So a day part, in restaurant terminology, refers to the specific time of day, breakfast, lunch, dinner, or late night. A dual day part offering means they are using the IP to attack multiple behavioral routines.
So not just one meal.
Right. They are likely offering a specific combo for lunch, but tying a secondary digital reward or exclusive content drop to a late night visit, perfectly aligning the food consumption with the act of binge watching the show.
So they are trying to double dip the same customer in a 24-hour window.
Yes.
But the phrase digital activation in the app feels like the real magic trick here.
Oh, it is the core of their margin strategy. They are utilizing massive global pop culture IP as a loss leader or a magnet to force consumers into their proprietary digital ecosystem.
Think about it like a freemium software model. The basic app is free, but the pop culture tie-in is the exclusive feature that gets you to finally hit the download button.
Exactly.
And once you download it.
Once the application is on your device, the balance of power shifts entirely. McDonald's now owns your behavioral data. They track exactly what you order, what time of day you visit, and how price sensitive you are.
That's powerful.
And more importantly, they own the communication channel. They can bypass the physical drive-through menu board and the television screen entirely, sending targeted push notifications directly to your pocket.
So they know exactly what buttons to push.
Right. If the algorithm knows you always buy a coffee on Tuesday mornings, it won't offer you a discount on coffee. It'll offer you a high-margin pastry at full price, dynamically bundled with the coffee.
Here's where it gets really interesting. Just look at the staggering breadth of the IP they're leveraging across this system. Super Mario Galaxy Happy Meals to capture the young families.
Yep.
Past activations with Minecraft and the Grinch. And then the CEO teased the upcoming juggernaut, their FIFA World Cup sponsorship, capitalizing on the tournament being held across North America, the US, Canada, Mexico.
Huge.
They have engineered a cultural hook for every single age bracket. Friends for the parents, K-pop Demon Hunters for Gen Z Mario, and Minecraft for the kids.
This multi-generational targeting allows them to turn a standard family dinner decision into a multi-variable incentive structure.
Yeah.
The parents might want the nostalgia hit, the teenager wants the digital app content for the K-pop band, and the child wants the Mario toy. The friction of deciding where to eat is eliminated because the cultural gravity is pulling the entire household in the exact same direction.
And the CEO framed this not just as generating buzz, but as a structural traffic driver. They treat these intellectual properties like modular software that can be plugged into their global operating system.
Because the competitive advantage here is scale. Very few organizations on Earth possess the logistical capability to test a culturally relevant insight in a localized market, say an emerging anime in Japan or a hyper-specific music trend in South Korea.
Right.
Analyze the app, download conversion data, and then instantly scale that exact campaign across 40,000 global restaurants. They are arbitraging local culture into global revenue.
Think about your own media consumption. You're streaming a show, you're playing a video game, watching a soccer match. McDonald's isn't just buying ad space next to the content you love. They are physically manifesting that digital culture into an edible event in the real world.
And by creating scarcity around these IP partnerships, offering the K-pop meal or the specific digital reward for only a 2-week window, they manufacture urgency.
FOMO, basically.
Exactly. The consumer might not have organically desired a burger that week, but the fear of missing out on the cultural event overrides their normal consumption pattern.
Which is brilliant digital architecture. But at the end of the day, when the app notification fires and the consumer pulls up to the window, you still have to hand them a physical product.
True.
You can have the best app interface, the most compelling Netflix tie-in, and the smartest $3 price point. But eventually you have to sell food. And that brings us to the menu battlefield. Because reading through the third pillar of their playbook, menu innovation, it becomes incredibly clear that inflation is actively dictating the physical composition of their menu.
Yeah, the transcript dedicated significant time to a massive global shift in protein economics. The executive team extensively discussed the chicken boom.
The numbers management provided were just staggering. They stated that the chicken category is now larger than beef globally, and crucially, it is growing twice as fast.
Fast growth, yeah.
But here is the competitive reality they admitted to. McDonald's has a mid-40% market share in beef. They are the undisputed heavyweight champion of hamburgers. But in the chicken category, they only capture a high teens market share.
And that gap represents a massive vulnerability, but also their single largest runway for growth. Moving their chicken market share from the high teens to the low 20s represents billions of dollars in incremental revenue.
Billions.
Yeah, and the CEO proudly noted they have recently gained about 2 points of share in chicken.
But why this sudden, aggressive pivot to poultry? It can't just be that consumer tastes organically shifted overnight, right?
No, it's driven by brutal commodity economics. The transcript points out that beef inflation is sitting at historic highs, specifically calling out the European market as being under intense supply chain pressure, though the U.S. is facing similar constraints.
Walk me through the mechanics of that. Why is beef so much more susceptible to inflationary shocks than chicken right now?
It comes down to biological life cycles and feed conversion ratios. The timeline to breed, raise, and harvest cattle for beef is approximately 18 to 24 months.
Okay, that's a long lead time.
Exactly. And this requires massive amounts of land, water, and crucially, feed like corn and soy, which are themselves subject to extreme price volatility due to weather and geopolitical issues. If there is a drought, the cost to feed cattle for 2 years skyrockets.
Right, that makes sense.
In contrast, the biological life cycle of a commercial broiler chicken is roughly 45 days.
45 days versus 2 years. Wow. The agility of the supply chain is completely different.
Exactly. And the feed conversion ratio, which is the amount of feed required to produce 1 pound of meat, is exponentially lower for chicken. Therefore, the baseline commodity cost of chicken is structurally lower and far less volatile.
I see.
When the wholesale cost of beef spikes, the profit margins on a Big Mac or a Quarter Pounder are severely compressed. The corporate entity, and more importantly, the local franchisees, make significantly less money on every burger sold.
And if they try to pass that massive beef cost directly onto the consumer by raising the price of the Big Mac to $12, they violate the first pillar of their strategy value, and the consumer simply stops coming.
Exactly. It all breaks down.
So how do they protect the franchisee's profit margin without alienating the customer?
They execute a highly calculated diversion of consumer demand. They aggressively promote chicken.
So all these massive marketing pushes for the hot honey chicken sandwich in the U.S. or the rollout of the chicken Big Mac in Germany. This is financial engineering disguised as culinary innovation.
It is a masterful redirection of volume. By leaning heavily into chicken promotions, they offer the consumer newness and exciting menu innovation, fulfilling the third pillar of their playbook. But operationally, they are steering the consumer's palate toward a protein that actively protects their profit margins. It mitigates their exposure to the volatile beef markets without requiring punitive price hikes on the core burger menu.
So saying, hey, try this amazing new hot honey sauce translates in the boardroom to, thank goodness they bought the chicken because we can't afford to sell them the beef.
Exactly.
It's incredibly smart. But chicken wasn't the only defensive maneuver on the menu. They devoted a surprising amount of time to discussing the beverage wars.
Yes, big moves there. They announced the launch of a massive new U.S. beverage platform under the McCafe brand, focusing heavily on refreshers and crafted sodas.
Right.
They also highlighted that Germany and Canada have recently launched similar beverage-focused platforms.
There was a very revealing moment during the Q&A segment regarding this rollout. Management had previously teased that Red Bull-infused energy drinks were going to be a major part of this launch. And an analyst explicitly asked why those Red Bull drinks were missing from the current lineup.
I noticed that too.
The CEO admitted they were delayed due to operational readiness, but confirmed they are still coming later in the year. Now, what does operational readiness mean in this context? Pouring an energy drink over ice doesn't seem like it requires a massive operational overhaul.
Well, operational readiness in a system of 40,000 restaurants is a monumental hurdle. It implies that introducing a new liquid, a new ice ratio, and a new mixing procedure disrupted the speed of service during peak hours.
Because speed is everything.
Exactly. In the quick service industry, seconds dictate profitability. If a new crafted soda takes 15 seconds longer to prepare than a standard fountain drink, and you sell 100 of them during the lunch rush, you've just added 25 minutes of delay to your drive-through foot.
And people just leave.
Right. That delay results in cars pulling out of line and lost revenue. They have to engineer the physical workspace where the cups are stored, how the syrups are pumped to ensure the new product doesn't bottleneck the entire restaurant.
That makes sense. But let me propose a theory here on the broader strategy, keeping our Talk Ticker's actionable analysis in mind. When I read about crafted sodas, fruit refreshers, and Red Bull-infused energy drinks, I see an attempt to replicate the Starbucks model.
Oh, for sure.
If they can get a consumer hooked on a daily afternoon habit of buying a crafted beverage, that is a pure margin play. Selling flavored liquid and ice has vastly higher profit margins than assembling a complex, multi-ingredient chicken sandwich. Are they slowly pivoting to become a beverage-first company to protect their bottom line?
It is a highly margin-accretive strategy, undoubtedly. Beverages represent the highest percentage profit margin of any item on a restaurant menu. But the strategic brilliance lies in day-part expansion.
Explain that.
A beverage-heavy platform specifically targets the mid-afternoon slumpy hours between 2:00 p.m. and 5:00 p.m.
Right, the historically dead hours for a burger joint.
Precisely. A consumer is highly unlikely to desire a quarter pounder at 3:30 p.m., but they frequently desire a caffeine hit, a sugar rush, or an energy boost.
So it's basically free money.
Essentially, yes. By offering Red Bull refreshers, McDonald's is creating highly profitable incremental traffic during hours where their fixed costs, rent, electricity, baseline labor are already being paid. They are monetizing the dead air in their daily schedule.
Up to this point in our analysis, the narrative presented by management sounds like a flawless tactical victory. They have the value menu locking down the low-income tier, the app and pop culture marketing capturing the high-income tier, and chicken and beverages insulating their profit margins against inflation.
Right. Sounds great.
But the earnings call featured a moment of surprisingly blunt transparency from the CFO, Ian Borden, regarding their own company-operated stores. So if you're looking for the bearish signal in this transcript, this is it. Let's look under the hood at the P&L reality check.
Yeah, this was arguably the most striking moment of the entire transcript. McDonald's operates on a franchise model, meaning the vast majority of restaurants are owned by independent operators.
Mom and pop owners, basically.
Yeah, exactly. However, the corporation still owns and operates a small percentage of stores directly. And despite generating $3.6 billion in restaurant margins globally across the entire system and boasting a 46% adjusted operating margin, the CFO explicitly stated that the margins at the U.S. company-operated stores referred to internally as McCupcomb were not acceptable.
You rarely hear a CFO on a public earnings call use language that strong and punitive about their own internal operations. Not acceptable. Why? What went fundamentally wrong at the corporate-owned locations that didn't go wrong at the franchise locations?
Well, the CEO, Chris Kempczynski, elaborated during the subsequent Q&A session. He pointed to two compounding factors. First, the corporate stores invested heavily in additional labor, aiming to improve service times and operational metrics.
Okay, more staff.
Right. Second, simultaneously, the corporate pricing strategy was overly conservative. They were hesitant to pass the rising commodity and labor costs through to the consumer via menu price increases.
So they deliberately squeezed themselves from both ends of the P&L sheet, intentionally raising their operating costs while artificially capping their revenue.
Which resulted in severe margin degradation.
But the proposed solution is what truly fascinated me. They stated they are actively reevaluating the balance of franchisee versus company ownership. Essentially, management signaled that if a local independent franchisee can run a specific store better and generate higher margins, McDonald's corporate will gladly hand over the keys and refranchise that location.
Yep.
I need you to help me understand the logic here. The corporate headquarters in Chicago possesses virtually unlimited resources. They have teams of data scientists, complex pricing algorithms, global trend analysis, and massive purchasing power.
Sure.
How on earth is a local franchise, someone who maybe owns 5 or 10 stores in a single county, beating the corporate mothership at margin control? Is central planning just inherently flawed in this industry?
It really highlights the fundamental limitation of macro data versus micro agility. The corporate office has brilliant algorithms, but those algorithms operate on averages and aggregates. A local franchisee operates on hyper-local reality.
Give me an example.
Let's look at labor optimization. A corporate algorithm might mandate a specific staffing level for a Tuesday afternoon based on historical national trends. But the local franchisee knows that the high school down the street just changed its bell schedule, or that the local factory just shifted its shift change time. The franchisee can instantly optimize their crew scheduling to match those hyper-local micro rushes, avoiding unnecessary overtime or idle labor hours.
They can manage the floor minute by minute in a way an algorithm in Chicago simply can't.
Furthermore, consider waste management. When a corporate manager drops a basket of fries, it's a fractional rounding error on a billion-dollar spreadsheet.
Right.
When a franchisee drops a basket of fries, that is physical currency vanishing from their personal bank account. The incentive structure drives a ruthless, granular focus on operational efficiency at the prep station.
And what about pricing? Because corporate admitted they were too conservative. Does the franchisee have a better read on what the customer will actually pay?
Absolutely. The local operator possesses an intuitive grasp of hyper-local price elasticity. They understand the exact economic threshold of their specific community. They know precisely how many cents they can raise the price of a medium Diet Coke before the local construction crew decides to stop coming in for lunch.
Because they literally see those guys every day.
Exactly. Corporate mandates paint with a...
But this dynamic between corporate mandates and local economic reality creates intense friction, particularly regarding capital expenditures. The transcript extensively discussed reevaluating their pipeline for building new restaurants. They have a stated public goal of hitting 50,000 global locations by 2027. But now, they are reconsidering the pace of that expansion based on rising construction and supply chain costs.
Yeah, because the inflationary environment impacts not just the cost of beef, but the cost of steel, concrete, and commercial HVAC systems. Building a new restaurant is significantly more expensive today than it was modeled to be 3 years ago.
Right.
But the tension isn't just about new builds, it deeply affects the existing footprint. The transcript touches on the looming 10-year remodel cycle, known internally as EOTF, or Experience of the Future.
Right. Roughly a decade ago, McDonald's initiated a massive system-wide remodel cycle. They required franchisees to modernize their stores, installing touchscreen, ordering kiosks, updating the exterior facades, changing the interior decor.
And standard franchise agreements typically dictate that the physical restaurant must be refreshed on a specific timeline. That 10-year clock is currently ticking toward another required capital expenditure cycle.
Oh boy.
Now, put yourself in the shoes of a franchisee. Your cash flow is currently pressured by historic beef inflation, rising labor costs, and the need to offer $3 value meals just to keep traffic flowing.
Right, you're stressed.
And right at this moment of maximum financial stress, the corporate office reminds you that you are contractually obligated to spend hundreds of thousands of dollars to remodel your dining room.
That is a recipe for a franchise revolt.
It creates immense systemic friction. Management must navigate this incredibly carefully. They have to ensure that any mandated remodel, any capital expenditure they force upon the franchisee can demonstrably deliver a clear, mathematically sound return on investment through increased sales or improved operational efficiency.
Otherwise.
If they force a remodel that doesn't yield higher revenue, franchise profitability collapses and the entire system fractures.
This delicate tightrope walk between corporate strategic vision and local economic survival is the defining characteristic of the franchise model. And this exact tension is perfectly illustrated when we look at their performance on the international stage. Let's look at a tale of two markets. The transcript provides a very clear scorecard of where the 3-for-3 strategy thrived globally and where it completely face-planted.
Yeah, the international segment serves as a series of massive A/B tests for their strategic framework.
Right.
In the wins column, management explicitly highlighted the UK, Germany, and Australia.
Okay, good to know.
And the CFO noted a crucial data point. All three of these markets gained market share despite operating within a broader quick-service restaurant industry that was actively contracting.
So the overall pie was shrinking, but their slice got bigger.
Exactly.
They specifically praised Australia as the golden child of the quarter, noting they achieved mid to high single-digit comparable sales growth by successfully executing all three pillars of the playbook simultaneously. But the commentary on the United Kingdom market was even more revealing. The CEO framed the UK as a successful turnaround story, specifically noting they fixed internal franchisee profitability issues by pivoting away from chasing traffic at the expense of profit. Now, what exactly does that mean? How do you chase traffic in a way that hurts the business?
It indicates a previous strategic imbalance. In the past, the UK market leadership likely pushed deep, aggressive discounts to drive sheer transaction volume. They wanted bodies in the door.
At any cost.
Right. The problem arises when the discount is so steep that the local franchisee is actually losing money on every transaction. You can drive infinite traffic if you sell a burger for a penny, but you will bankrupt your operators in a week.
That makes sense.
The turnaround in the UK meant establishing a disciplined value architecture like the flexible meal deal. Plus, we discussed earlier that drives incrementality without destroying the unit-level economics. They found the equilibrium between volume and margin.
But then we look at the laggard column. France. The CFO explicitly called out the French market for failing to meet expectations, and the diagnosis provided on the call was brutally straightforward, a lack of consistent discipline in their execution of value. If we contrast the success in the UK with the failure in France, what is the core lesson here? What happens when a market loses discipline?
France serves as the ultimate cautionary tale for the entire corporation. It demonstrates exactly what occurs when a regional leadership team ignores the foundational defensive pillar of the strategy.
The value pillar.
Yes. If a market fails to maintain a highly visible, compelling entry-level value tier, if they abandon the equivalent of the $3 EDAP menu, they leave themselves entirely exposed. In a highly inflationary European environment, where consumer anxiety regarding the cost of living is acute, a brand simply cannot survive on historical reputation or premium, high-margin offerings alone.
You can't just sell the fancy burger and expect people to show up out of loyalty.
Exactly. If you do not provide a credible safety net for the financially stressed consumer, that consumer will instantaneously abandon you for a competitor who does. France lost discipline on affordability, focusing perhaps too heavily on premiumization, and the macroeconomic environment punished them severely for it through massive traffic defection.
Oh.
It proves empirically that the entire 3-for-3 architecture collapses if the value pillar is removed.
Now, in the context of international operations, we have to address a major geopolitical issue that was brought up by analysts on the call: the ongoing war in the Middle East.
Yes, that was addressed.
Management stated that the conflict did not have a material impact on total company financial results in Q1, given the massive global scale of the business. However, they readily acknowledged that the operating environment in that specific region remains incredibly challenging. And remember, we're not taking any political stances here, just reporting what the executives laid out as their operational reality.
Right. And the messaging from executive leadership regarding the Middle East was highly structured and highly specific. Their stated stance focused entirely on supporting the local franchisees, mitigating localized operational costs within their direct control, and protecting the long-term financial health of the franchise system in the region.
I find the corporate mechanics of this fascinating. We're talking about a massive, tragic geopolitical conflict. Yet on an earnings call, multinational corporations treat these events largely as localized supply chain disruptions and franchise support issues. How does a brand navigate that level of global complexity without becoming entangled in the geopolitics themselves?
It is the defining operational reality of a truly borderless, multinational corporation. When a brand operates tens of thousands of locations across nearly every sovereign nation on Earth, it is statistically inevitable that it will be exposed to regional instability, warfare, and shifting political winds. From a purely operational and fiduciary standpoint, the corporate entity must compartmentalize these crises.
They build a firewall around the regional business unit.
They operate as a business entity, not a political state. Their stated fiduciary duty, as articulated on this call, is to protect their local operators, the franchisees whose personal livelihoods and local workforces depend on those specific restaurants remaining solvent.
Right.
They focus strictly on ensuring operational continuity, supply chain logistics, and local financial health, deliberately separating the mechanical operation of the restaurant from the broader geopolitical complexities. It is a necessary survival mechanism for global scale.
It is a stark reminder of the sheer magnitude of the operation we are analyzing. So if we look at the bottom line here, for anyone holding or considering the stock based on these results, what are we seeing? To synthesize everything we've unpacked in this deep dive, the balancing act McDonald's is attempting to pull off right now is nothing short of an economic high-wire act. They are fighting a war of attrition on multiple, highly distinct fronts simultaneously.
They're actively engineering pricing structures to woo the cash-strapped, lower-income consumer who is rationing gasoline, utilizing $3 EDP safety nets to keep them in the ecosystem.
And in the exact same physical building, they're deploying highly produced Netflix K-pop integrations and crafted sodas to lure the resilient, high-income consumer who just wants an afternoon treat and a digital reward.
And they are navigating historic margin-crushing commodity inflation in the beef supply chain by executing a massive global marketing pivot to convince the consumer base that they are, in fact, a premier chicken destination.
And all the while, the corporate executives in Chicago are wrestling with their own internal P&L sheets, demonstrating the humility to admit that an independent franchisee in Ohio or the UK possesses a far superior grasp of hyperlocal pricing elasticity, labor scheduling, and deep fryer management than their own corporate mandates. So it's a bullish signal for the franchise model, but a warning light for corporate store margins.
It is a masterclass in dynamic macroeconomic adaptation. Every menu change, every app notification, and every price adjustment is a calculated reaction to real-time consumer data.
And that leads me to a final thought I want to leave you, the listener, with today. Think about the massive upcoming beverage platform we discussed, the refreshers, the crafted sodas, the Red Bull infusions. And think about the aggressive, relentless push toward the digital app via global IP partnerships like the World Cup and Netflix. As McDonald's focuses more and more of its capital on app-based data collection, algorithmic loyalty programs, and highly profitable, easy-to-pour liquid beverages, are we watching a fundamental corporate metamorphosis?
It really makes you wonder.
Are we watching the world's most famous burger joint slowly, imperceptibly evolve into a tech-driven digital logistics company that just happens to sell high-margin energy drinks and chicken sandwiches on the side to fund its data acquisition?
That's a fascinating way to look at it.
The diagnostic landscape of the global economy might be hard to read right now, but the trajectory of this specific company is absolutely fascinating. Keep a very close eye on your next drive-through receipt and pay attention to what the app pushes to your phone at 3:00 p.m. It might just tell you exactly where consumer psychology is heading next. Until next time, keep diving deep.